Friday, the 17th of November, European stocks continue to march higher. Wow, what a week we have seen. Oil's coming back, London is outperforming, but most of the major European markets have had a sensational week. The DAX on the week up by nearly 4.5%. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Stock 600 up by 1%. We're off to the races. It is obviously Las Vegas this weekend, so I pulled out a kind of car theme into the show. Volvo cars down by 10%. Geely selling a big stake. That weighing on that stock down by 10%. Look at that. Aston Martin selling a stake in its business, a small one. Lawrence Stroll selling that, but the valuation it puts on the business around $1 billion. That's an incredible turnaround for Aston Martin. But you want the real story? It's actually not here. Ferrari, yet again, another 52-week high. Race definitely off to the races, Shonali.
Absolutely, but over here in the United States, we are hitting the brakes. Keeping with your car theme over there, Guy. We're looking at an S&P 500 virtually unchanged on the day, but the NASDAQ 100 down about 0.2%, and that coincides with also yields off its lows, up about 5 basis points today. That bid also fading in the bond market as well as those high-tech stocks. Now, New York crude, let's look at this for a second because this is where the bear market had begun. You're looking at it about 3% higher, so that is the one place you are starting to find some relief.
Shai, let's just put some numbers around all of this and talk a little bit about what's been happening. Stock 600, these are 1 month numbers. S&P up by 3%. Over the last 2 weeks, it's been even higher. So month to date, even higher. Stock 600 up 1.35. But over the last 2 weeks, the rally's been there. But look at crude. Crude's down by 11%. Is that the real signal in all of this? And what do we make of this? Look at that 29 basis point lower over the last month, Shonali, in the German 10-year. Is that signaling the central banks are in a position where they can cut because inflation's coming down? Or is that signaling that inflation is coming down, but it's coming down because growth is fading and central banks are going to have to cut because we've got a growth concern building? I'm not sure which one it is yet. The soft landing narrative may turn into the hard landing narrative. But at the moment, all of the different asset classes sending slightly different signals. Stocks, I think, in some ways, you could argue the most confusing one. What are they reacting to right now? Is it that lower yield because inflation's coming down, or is that lower yield because growth's coming down? Because if it's the latter, then maybe this rally starts to fade.
Yeah, there's definitely more where that came from. We also spoke to PIMCO's Geraldine Sundrum earlier today on Bloomberg Television on how she's positioning in this risk rally.
It's hard to see this market with like a really big broadening rally beyond some secular area or tech-related area that are still seeing a lot of growth. So we're cautious, but we're not calling for a crash of the market.
Geraldine Sundrum, let's go back to our question of the day. What do you do here? Fade the rally? It's been a big one over the last few days, certainly in bonds and in equities. Noor Al-Ali and Eddie van der Volt joined us now from our M-Live team. Noor, what do you think? Fade it or chase it?
Look, it really depends. Do you think the fade right now is leading to the economic growth concerns? Or is it, banks have to cut rates very soon, so this is the time for us to, ride that bullish wave, and whatever side of that camp you're on, you're going to position yourself accordingly.
Now, what do you think about this idea of the bond market as well and the relative strength that it's had in the United States relative to other places in the world, Eddie?
Yeah, I think the bond market is the key here, right? But because I think there are so many different stories, I do think that for equities, what we're looking at is, I think it's off to the races. I think it's the Santa rally coming early here. I think for the bond market, it's much more nuanced. But with the bond market, I think, investors have now priced in a lot of cuts in the US going into next year. And I just don't think that you're going to see, much more downside in yields over the next couple of months. What you're much more likely to see is more steepening. You're likely to see that steepening trade coming back. The 10-year yield, the 30-year yield doing its own thing. And then the oil market, completely different story. Pricing out some of that Middle Eastern risk, but at the same time, not falling below those levels beyond which OPEC would want to start cutting production again.
Yep. Eddie, the issue, I understand all the fundamentals, and we don't know whether it's a hard landing or a soft landing. But at the moment, it's Goldilocks collides with Santa. The story in terms of the seasonality is very, very positive. The story in terms of the economic data looks fairly positive as well. Maybe we get that soft landing. And this market feels like it's getting some momentum behind it. We're broadening out. Is that something that runs out of steam easily, or is that momentum starting to build? Is that positioning story starting to really build here?
Yeah, that's it. I love that Goldilocks, taking a ride on Santa's sleigh kind of imagery. But look, yes, I think because right now, what do you see? You probably see some money coming out of the bond market and going, where's it go? It's not going to go back into cash. It's going to go into the stock market, right? I think you're going to see the stock market benefiting from people saying, hey, we've been out of this rally for a long, long time. Maybe we get a recession, but that'll be next year's problem. And we're probably not going to price in more cuts this year. So, hey, we could go into stocks. I do think that there's going to be a thematic change, though, because people have been betting on mostly, on NVIDIA and on the chip sector and on the AI trade. But as we get to next year and we get to the US election, those chip stocks will be much more in focus on that relationship between the US and China. We already saw that have some impact in Europe today.
Nor, what is likely to crack the risk rally at the end of the day?
Well, look, I mean, if you're looking at some analysis from our BI team, you do see that U.S. stocks are actually the most expensive relative to bonds since 2002. Also, earnings yields aren't as promising or as reflective, when you compare them to bonds in the U.S. In Europe here, the story about economic growth is really weighing on sentiment. And you also have ECB policymakers pushing back on that market pricing, that very aggressive pricing of expecting interest rate cuts coming.
If those don't show up, if those cuts don't show up, and the market's pricing them now for spring of next year, and quite aggressively, if those don't show up, how mispriced, though, do you think both bonds and equities could be here?
Quite so, right? Because if you see the policymakers push back so much that they maintain their higher for longer stance as they are now, even with economic growth, dwindling and recession fears really coming to the forefront, that's the risk rally gone, right? I know we're enjoying it in terms of a Santa rally. You really cannot trade against the momentum. That is incredibly key going into very low volume weeks as well ahead. But if you're looking at the longer term prospect, if you look at the stock 600 in Europe, the year to date in basic resources, miners are the worst performers. That's because those concerns about economic growth do trump the picture for anything else. And that's going to put the ECB in a bind if they keep rates higher for longer while inflation does moderate at the pace that we're seeing it. That's economic growth really taking in the heat here, and they'll be forced to cut rates sooner than they say they will.
Eddie, we're talking about bonds, we're talking about stocks, but we have to talk about commodities too. And if you think about the pressure that the oil market has been seeing, where do you think it starts to really impact broader risk appetite?
Yeah, look, so the oil market has been pivotal here. And over the last couple of months, we've seen some really wild moves down from 70. And then the market saying, hang on a second, there's trouble in the Middle East, and running up to 100, coming back, pricing that out, and now testing the levels at which OPEC in the past has cut. The previous two interventions from OPEC came at about $75 a barrel on WTI. And we tested those levels again this week. So, we've got an OPEC meeting coming up just over a week from now. So I think the market I don't think the market will be testing OPEC too much once again.
Eddie, how useful a signal, though, is the bond market, is the oil market right now? What we're hearing, and we were talking about this earlier on in the program, is that it's not fundamental traders that are driving the price lower. It's algos. It's the more technical story. It's not really a fundamental demand signal that is coming out of the oil market. How useful is it, in your view?
Yeah, no. Look, I think the oil market does not work at all as a fundamental signal, because I think without OPEC intervention, it would be much, much lower. I think fundamentals are driving the oil price lower, right? The oil price had no business up at $100 a barrel. That was a geopolitical risk that drove it up to those levels. So it's coming back to kind of where supply meets demand. But at the same time, it can't go much lower from here because there is simply not, you just have to assume that OPEC is going to intervene. So it's a broken market. I would much rather look at things like copper and copper, gold. That would be where I take my reading from.
Do you think that those assets also face further pressures ahead, Eddie?
Yeah, I think so. Gold in particular has been, it's sitting up at $2,000 an ounce roughly, and that also still a lot of geopolitical risk in that price. It's really mispriced compared to where you would assume it would be based just on real rates. So I think that's probably the asset that has the most give back to give yet.
Our thanks to Eddie Vanderwalt and Noor Al-Ali from our Bloomberg MLive team. Coming up next, our question of the day, fade the rally. Zeynep Öztürk-Ünlü of Deutsche Bank Private Bank joins us next. This is Bloomberg.
I know you guys were reporting earlier today about the 40% of stocks are non-profitable, 30% of the Russell 2000 are zombie companies. And I think that's the area within any index that you want to stay decidedly away from and focus more on quality broadly, but specific factors like high interest coverage, low interest expense, strong return on equity, positive earnings trends, positive earnings revisions, and those factors sort of have a quality wrapper around them. That's the way I'd approach this point in the cycle.
That was, of course, Liz Zonders, Chief Investment Strategist at Charles Schwab, speaking to Sonali and I a little bit earlier on. That takes us back to our question of the day. It's been quite a move. Do you now fade the rally? Joining us now, Zeynep Öztürk-Ünlü, Deutsche Bank Private Bank, Head of Investment Solutions for Central Europe and the United States. Nice to see you, as ever.
Very nice to see you.
Are your clients chasing the rally? Are they getting ready to fade the rally? How are they thinking about this Santa Claus rally that seems to have already arrived?
In our portfolios, we run generally longer-term positions, and this is the advice that we give our clients. But one thing that we also say is we like to buy the dip. So there's this concept that we've been talking about since the beginning of the year, and we've been getting into more equities in particular when there is a dip. And the rally, of course, shows a great performance in the portfolios, which gives a very good motivation to investors. And if people are asking to get more, we then say, it's time to kind of be more sensible and stay where we are rather than adding and piling further risk. So in a way, we are not shying away from risk of what we have already built, but we're not building on further. And this is the kind of the sentiment that we see from our clients really enjoying, because it is more mid to longer term view and trying to avoid the noise, avoid the volatility as much as possible, and enjoy the benefits of staying invested.
To the extent that you are worried about certain markets, where is there the most risk at this point, in the bond market or the equity market?
I think it might sound a bit controversial. In general, equities are the highest risk compared to bonds, but I think bond market carries a little bit more risk, considering the fact that bond volatility have been significantly elevated and the reaction to rates is really high. In the past, we were able to distinguish between the rate and the credit, but it has kind of commingled quite strongly, and the correlation of the two is so strong, and liquidity is getting a little bit of a trouble at this point of the year, and with higher rates, policy rates, bond market is more prone to being a bit more risky, a bit more volatile. So I think I would put my risk weight a little bit more on bonds.
Okay. 2023 has been a year of noise. Is 2024 going to be a year of clarity? Are we going to get finally an answer to the soft landing, hard landing narrative? And how are you thinking about that kind of bifurcation, that fork in the road, when we know whether it's a soft landing or we find out finally that maybe it isn't the soft landing and the hard landing is going to hit us?
Actually, this can be a very good question to put on the Santa to see if there will be a response.
Is Santa going to give us an answer? I hope
exactly.
So. That would be good.
In a wishful thinking, of course, we would love to see a very clear year in 2024, but I don't think that will be the case, because what we will see is 24 will also price 25 in a way. Therefore, we also have quite a lot of headwinds that are hanging, coming towards 24. Nothing has been fully clarified. But a couple of things are a little bit better. We have better visibility in terms of the central bank positions. We have better visibility of the core macro drop. Inflation, where it is heading, is getting in a much more controlled way. Of course, there are still concerns with elevated energy prices and pressure onto inflation, particularly in Europe. But the macro picture is much better than where we were last year this time.
Zeynep.
It gives us a better picture.
Zeynep, when you're you mentioned commodity prices. I'm glad you did. Energy prices. How much can that throw a wrench in the story of inflation?
It can draw a range. In a way, if you look into what has been the experience of energy prices, we had a massive impact at the early part of the year, and then things kind of calmed down, and the core inflation, what we have been all looking at and the central banks have been looking at, was kind of stripped out of the concerns around the energy. But at the end of the day, it indirectly comes into everything that comes in production. Rentals even get impacted with the cost of living. So inflation gets impacted, not directly, indirectly. Therefore, it can weigh in. But where we are now, in a quite an unusual way, it's very controlled. So we don't see a specific number that we can add on our forecast that the cost of energy will weigh in to inflation as of now, based on these levels. But if things change and if things escalate and energy costs really dramatically increase, that will be a different story.
One of the stories we're going to be talking about later is the Biden-Xi summit that we've had this week. And a lot of investors, and I think the Bank of America's Fund Manager Survey talks about this. One of the most crowded trade right now is to be short China. Many people see China as being uninvestable. And I'm wondering whether or not you're starting to detect interest in the Chinese economy bottoming out and maybe 2024 delivering a better year, and whether or not improved economic data is going to be enough for people to kind of re-engage with China, or whether the other risks are still so great that actually people won't make that move.
This is an interesting one, because this is a very hard debate that we keep on having on our side, and we also try to look into not only macroeconomic dynamics but also a positioning of some of the other institutional investors or retail investors, money coming into China or money leaving China. And when you look into all these together, maybe the macro picture doesn't give us a fantastic outcome because of the overhanging real estate market crisis, and it's a big one because the impact on GDP is significant, more than 30%. But at the same time, when you look into the businesses, mid to large businesses, and even the small businesses in China, they want to just get on with their growth, their business plans, and then you see liquidity is coming up. So the local regions within China might be struggling more, but the overarching available, less debted, high liquidity position of China economy is showing us that actually that can be a turning point for China. So we're not that negative, I have to say, but we're very cautious.
Are you that positive?
Maybe not one or the other for now.
Okay.
Yeah.
Our thanks to Zeynep Öztürkoğlu of Deutsche Bank Private Bank. This is Bloomberg.
I think each of the races has a different character, and they're very have characteristics which make them unique and special and all worthy. I do think Vegas is going to be unique in that it's a night race down the strip on a Saturday night. I think it's going to be iconic. The visuals will be amazing. And I am not worried about demand because we have been lucky enough to see interest in Formula One explode here in the U.S.
Liberty Media's CEO, Liberty, of course, the parent company of F1, speaking to Bloomberg yesterday. The Las Vegas Grand Prix this weekend. It's taken a while to get here. 4 decades. It's been a long journey, and it's not exactly quite going according to plan. Firstly, maybe the interest isn't as high as we thought it might be. And then we've had this issue with the first practice session. It was cancelled, I think, 10 minutes. I think Carlos Sainz got 10 minutes in, and then the car told him to stop. Basically, I think he'd hit a manhole cover on the track. This is obviously a street circuit, and I think he's hit a manhole cover. I think he's taking a grid. He's going to be hit with a grid penalty, Shonali. And I know you're interested in this, as a result of him hitting that. And I think we are going to see the second practice coming up. I was joking earlier on, Shani Basak, I was like, yeah, Formula One, it's going to be great. Las Vegas coming up this weekend. She went straight to private equity.
Of
She's
course
like,
I did.
Yeah, but how do they make money? What's going on?
Listen, it's fascinating because you're watching U.S. private equity investors get into teams like Aston Martin. But listen, you also have not only some pressures on the attendance over there potentially in Las Vegas for this event, you also have U.S. TV audience down for the F1 series. You also have the Netflix series getting less interest. So what does this mean for profitability for these guys getting in right now?
Maybe it takes a little longer to get there. Trying to transport sports and take them into different jurisdictions, I think, is turning out to be a little bit more difficult, and it takes maybe a while to get there. But I find it fascinating, the way that basically they're allying the sport with basically kind of reality TV. The Drive to Survive series. Have you seen the golf thing they're doing now, the Netflix Cup? You've got pro golfers and Formula One drivers playing golf against each other, with each other. And that kind of commingling of all of this kind of media property with sports property, I do wonder whether or not actually they finally figured out maybe how to get people interested in a little bit quicker, maybe, than they were before.
But you're watching the globalization of golf, the NBA, cricket, and you have to wonder whether the audience is oversaturated and which one will win out at the end.
Yeah, I think the IPL is going to be really interesting. The interest in cricket in India, that feels like it could be one of the big next steps in that. Already huge, could even get bigger. Anyway, we'll see who wins this weekend. Carlos Sainz didn't do well on the first practice round, but I understand that he did win the golf. So there's something there, at least. Let's talk about where we are with the markets. We're going into the close. European markets have had a really solid day today. You've got the 5-day story here, as you can see. Picks up midweek. We get another gap higher today. On the week, we're up by 2.8%. Check out some of the 52-week highs. Fascinating to see the mix, the breadth, maybe, of what we're seeing here today on the session. NL, you've got Svenska Handelsbank doing well. You've got BE Semi. You've got Danske Bank doing as well. I think it is Svenska doing well as well. Ferrari, and I thought I'd just finish up on that one as well, hitting a 52-week high as well today. That stock continues to be definitely at the races. Anyway, we'll have more detail in a moment. The European close is coming up. The pop back in oil prices certainly having an impact as well on the London market today. It's been a bad week for the energy sector. Today, a little less so. Anyway, the close is coming up next. More details to follow. This is Bloomberg. So here we go. We're wrapping up the European session. It's been quite the week. FTSE 100 outperforming, energy stocks come back. Nordics continue to do very well. Norway, Denmark, Sweden, all bright green today. It was SCA hitting 52-week high, by the way. Just get that one correct. DAX up by 0.8%. CAC up by 0.9%. But a sea of green, basically, across the main markets here in Europe. It's been quite the week for European indices. The DAX up by 4.5%, but broadly we're up by, let's call it on average, 3.5%. Let me show you what the week has looked like. This is the picture. Started fairly cautiously, but really got into gear Tuesday. And then a little bit of a fade with another pop coming. But look, we're up by, let's call it 3% on the Stock 600 this week. It's been an impressive performance, similar, maybe a little bit of outperformance actually versus what we've seen over in the United States, where the Russell has certainly popped back quite strongly as well, though. In terms of the single stocks that we are watching today, there's a car theme here. I do this in honour, of course, of what is happening over in Las Vegas this weekend with the Formula One race there. I've got a car theme. Volvo cars down 11.14%. The reason for that, Geely selling a stake in the business. Aston Martin, a stake sale, but getting a very different reaction. That stock up by 5.65% in advance of Las Vegas, selling a stake in the business to private equity that basically puts a valuation on that business of around $1 billion. Lawrence Stroll has pushed very strongly and now starting to see some significant rewards. And I finished with Ferrari. Stocks up by 1.14% today. Hasn't had a particularly good first round in terms of qualifying in Las Vegas, but it's had another 52-week high today. The stock has continued to do well. This is one area where margins seem to be fairly stable. And actually, demand continues to be fairly strong. Let's talk about what next week is going to bring. We've got a busy week coming up, lots of Fed speak coming up as well. I just want to flag something that's happening after the bell today. Not instantly, but over the next few hours, you're going to see this Moody's rating review of Italy. Just keep an eye on that. Are we about to go into junk status? That is going to be critical. I'm going to be about to sneeze here. Monday, Andrew Bailey speaking. Tuesday, we get EU new car registrations, continue the car theme. Wednesday, we get the autumn statements, the budget out of the UK. Are we going to be seeing some tax moves here by the Chancellor, Jeremy Hunt? Very keen. I think the business view certainly is that we would like to see some stability in terms of the tax story going forward, in terms of investment. Is he going to be able to allow that? The backbenchers in the Conservative Party would like to see broader tax cuts. The market may not allow that, though. And then on Thursday, we get the ECB accounts, the minutes, and then we get some flash PMI data as well at the end of the week. Keep an eye on that. What is that going to signal, Shonali, about the slowdown potentially we are seeing here in Europe?
Yeah, speaking of the slowdowns, if there are any jitters that are surrounding that Moody's impending review of Italy's credit rating, it is not yet showing up in BTPs. Aaron Captain, chief economist at UBS, joins us now. Aaron, if we think about just kind of the concerns around the fiscal situation over in Italy and what we're seeing around the rest of the world, how concerned are you really?
Actually, not that concerned. So, the debt dynamics are almost stable. If they do another 1.5% of GDP in adjustment, then things sort of start to stabilize. That's sort of similar to where the UK is, for instance, right? So in that sense, it's not that different. They've got pretty favorable supply dynamics moving forward, just because there's so much recovery fund money left. And then you still got the ECB support in the form of TPI and the PEP reinvestment, and politically things have been reasonably stable. So it's not obvious what the trigger would be for a downgrade if it were to come today.
If we were to get it, though, how big a reaction would we see?
I mean, it's definitely a tail risk. I think it's difficult to short the BTPs given the ECB sitting on the sideline, and usually you need a trigger to sort of create a critical mass of confidence that other people are going to short it, and that's how you get a big market move. And so a rating downgrade is something that certainly mechanically people will then perceive to reduce demand, and that's going to have some price impact. If it's just Moody's, though, I still think it's a pretty contained move.
Okay.
When you think about moves, where do you think the more pronounced opportunities are in the markets here when you're looking at BTPs versus what's possible for you in the U.S. or the Eurozone?
So actually, BTPs, we have pretty range-bound going into next year. So actually, we think we end next year maybe a little bit below where we are now. Right, so we actually don't actually have spread widening. We think actually next year we will get some adjustment. Italy's going to be back in an excessive deficit procedure, so there's going to be some European shackles on the ability to ease fiscal policy, and so we think it's sort of range bound. I think the upside is much more in sort of government fixed income curves, particularly at the front end, where there's just not nearly enough easing price. So for us, it's not so much a spread trade; it's more sort of a central bank normalization trade where we have 3 times as much easing in our forecast as is priced by markets in the next couple of years.
Why are you so concerned? What is driving that concern that you think the central banks are going to have to ease much more aggressively?
It's not really a concern. It's sort of a reversal of the excess tightening, right? So as an example.
What drives it? Is it inflation coming down benignly? Yeah. Or is it growth decelerating sharply?
Well, so in Europe, both, right? So Europe is not growing. We have inflation. I think the verdict is out on the last mile, right? I think we have to sort of see, but there's no sign of it getting stuck so far. So the speed of disinflation is pretty impressive. If the ECB does nothing until June of next year, real deposit rate, so the real ECB policy rate, will be at an all-time high. If they then still do nothing until early 25, we're going to be at over 2 percentage points in real terms. The historical average in Europe is minus 0.7, right? So you're just becoming more and more restrictive the longer you don't ease. And so that will become the trigger in the way it will be the trigger, we think, in the U.S. to start reversing the excess tightening.
Excess tightening. Now, when you think about the tightening story in the United States, I'm curious about whether you think that the Fed support is going to have to be a little bit more pronounced than perhaps meets the eye, given any potential concerns about liquidity next year.
So not so much about liquidity, although we do think, the base assumption we have is that the roll-off of the balance sheet stops in the middle of the year, and then by the end of the year, they're buying treasuries again, just because under the floor system, they're going to have to preserve an adequate level of reserves. So most of the support that we think is coming is really through the policy rate. And so initially, that will be what they themselves are forecasting. That's a disinflation cut, right? They have that in their own forecast. But we have a recession in the forecast, like quite a few of the other banks. And so, if you get that, then, of course, you get substantially more support. But that remains to be seen.
Let's turn from the monetary to the fiscal. How much room for manoeuvre does Jeremy Hunt, the UK Chancellor of the Exchequer, have?
About 20 billion, if you believe the OBR, right? So we're running about a percentage point below the forecast in March. So rather than ending up at 5% of GDP fiscal deficit this year, we're on track to end up at something like 4%. Now he could choose to spend, I think, the overperformance. The other thing I think you have to keep in mind is that overperformance came from slightly stronger growth and higher inflation in the first part of the fiscal year. Second part of fiscal year, that's probably going to reverse. So I think some of that overshoot is going to also reverse. He has less money to spend, I think, than meets the eye. The other thing on the UK, which I mentioned earlier, they are still, in the UK, we are still about a percentage point and a half away from even stabilizing the debt. So the OBR projection is we need a lot more fiscal adjustment. And so it's this balancing act between near-term sort of giveaways because you have some overshoot and actually not being on track yet to have the right landing zone for your debt dynamics.
What do you think the biggest challenges are for him for growth into next year then?
Well, the big challenge is that the mortgage fixtures continues to roll off, right? So I think the consumer is going absolutely nowhere. We have near stagnant growth. We have about a 0.5% growth next year. And it's sort of not obvious whether there's anything that's going to turn that around other than the improvement in real disposable income. So I think inflation is now falling quite rapidly. So it gives a little bit more support to consumption. But if you have 300,000 households resetting their mortgage every quarter, then that more than neutralizes that. So growth doesn't go anywhere. And so eventually, once we get, I think, the wage growth and the underlying sort of core inflation growth under control, then I think the Bank of England will be cutting quite rapidly.
How useful will the PMI, the flash PMIs we're going to get at the back end of next week, be? The PMI data has, for a while, told us that the economic story is maybe more grim than other data are. If we continue to see that data being bad, does that provide something useful? If the data starts to turn, does it provide something? I'm just kind of wondering how much weight you're putting on these numbers.
Not too much on one data point. So if it turns, it'll be interesting because it's been so bad for so long. And we look at, I think, at least 18 different sectors where the order books, particularly for Europe, are still running about 2 standard deviations below normal. They're getting better in Asia. And so one of the interesting things, I think, at some stage, the trade cycle has to turn. We're seeing the tech cycle turning, not necessarily going to help Europe, but there has to be a bottom at some stage. And so certainly every PMI print is sort of, is this the moment that we start to see a turn? We're seeing very little by way of data that would suggest that's about to happen.
Great to see you. Thanks for stopping by on a Friday. Really appreciate it. Aaron Captain joining us, Chief Economist at UBS. The European equity markets are now done for the day. We await that Moody's review. Equity markets finishing near session highs, little tick higher during the auction, not quite at session highs, but these are the final numbers. The oil price popping back a little today, providing some room for the FTSE to outperform a little bit. But it's been a very strong week. The DAX is up by 4.5% on the week. Coming up next, what are we going to talk about? It's been a big week for China. Just been talking about what's been happening out in Asia. APEC leaders are all headed home after a week of meetings in San Francisco. One of the highlights, of course, that meeting between Presidents Biden and Xi. More on the takeaways next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Coming up, Blackstone former president Tony James joining Bloomberg's Wall Street Beat tonight at 6:30 p.m. New York time. This is Bloomberg. So the APEC summit in San Francisco finally wrapping up today. Of course, one of the most closely watched events was the meeting between Presidents Biden and Xi. Bloomberg's Jennifer Welch joins us for the takeaway. She was a member of the U.S. National Security Council with a big focus on Asia. Great to see you, Jennifer. Thank you very much indeed for the time. Look, I'm really curious. You had the meeting between the two presidents, and usually what happens after this is you get a lot of spin, you get a lot of analysis. As we come towards the end of the week, kind of where has that spin and analysis centered in terms of the big takeaways from that meeting?
Well, I think a lot of the focus has been on sort of the positive vibes coming out of the meeting itself, the deliverables on resuming mill communications, on restoring the leader-level hotline, progress on fentanyl cooperation. But that's sort of been tinged a little bit by some of the comments that came during President Biden's press conference, in particular his remarks on Xi Jinping and China's political system. And it raised the question of whether or not that would undermine some of the progress that was made at the meeting. I don't think it will. I do think it speaks to the fact that the meeting was a positive sign, but it's not going to correct all of the differences and underlying tensions in this relationship. It's just a sign that they're managing those.
Well, what about the power dynamic here? What does it say in terms of President Xi's relative power as a growing economic force?
I mean, I think Xi remains very much politically in charge in China, and there's no real challenges to his consolidation of power there. I think what it does suggest is that he was coming to the United States looking to restore foreign investor, foreign business confidence in China amid some of their economic headwinds. And the APEC summit provided a really good opportunity to do that in two ways. One, project stability in the U.S.-China relationship through his meeting with President Biden. And two, directly speak to foreign businesses and foreign investors at the CEO summit and dinner that he attended after the meeting.
That meeting took a lot of the limelight. Out of the limelight, what was happening?
So this is taking place during APEC Leaders Week, the first time the U.S. has hosted it in over a decade, and a really good opportunity for the U.S. to demonstrate its commitment to the region, its engagement in the region, and that's what we saw the Biden administration really focused on and everything outside of this bilateral meeting between President Biden and Xi. So President Biden, Vice President Harris met with a lot of Indo-Pacific leaders. They really focused on U.S. economic engagement in the region, and they tried to advance progress on the Indo-Pacific Economic Framework, which has been the Biden administration's answer to U.S. economic policy in the region, given that CPTPP was not going to move forward, at least under this administration.
Now, what does this mean for the broader relationship between the U.S. and the broader region?
I think it was a positive indication, a positive opportunity, really, for Washington to demonstrate it remains focused on this really critical economic and geostrategic region, even amidst everything else happening in the world, with the war in Ukraine, the war in the Middle East, the U.S. election looming on the horizon. I think the challenge has often been with U.S. Indo-Pacific policy, and I speak as someone who used to work in this area. Again, with all the other challenges and priorities in the world, sometimes it can be difficult for the U.S. to devote enough focus and resources to this particular region. This is a good opportunity to show we're focused on it, but the challenge is how long will that persist and how will it proceed given these other trade-offs and priorities the U.S. has to juggle.
Jennifer, I'm really curious how you see corporate America interacting with White House policy. There is a desire in China maybe to get more investment into their country, and I'm wondering whether or not the primary way in which that's going to happen is by changing the political landscape or changing the message to corporate leaders. And I'm wondering how you think Xi got on with that latter messaging at this meeting.
Well, I think Beijing's strategy to date has been to try and target both elements of this. I'm sure he raised with President Biden in their meeting concerns about U.S. policies seen as containing China's economic and technological rise. I'm also fairly sure that he didn't receive much of a budge from President Biden on Washington's willingness to reconsider those policies. In fact, President Biden indicated in the follow-up press conference that U.S. was going to double down on those policies and continue to proceed with them. I think at the CEO summit, it was interesting. You saw a different, clearly a lot of business and foreign investor interest in China. People coming out, including Elon Musk and Larry Fink and others, to meet with President Xi at that dinner. So I think that indicates there's still tremendous enthusiasm or interest in the Chinese market from leading business leaders. And there's always going to be a push-pull here between national security interests in the U.S. and economic interests. And it's kind of an ongoing dialogue between Washington and the business sector on how to manage the national security risks while still maintaining an economic relationship with one of the world's largest markets.
Our thanks to Jennifer Welch, Chief Geoeconomics Analyst at Bloomberg Economics. Coming up next, the worst performing stock on the S&P today is Applied Materials, tanking on reports that it's facing a U.S. investigation for violating export restrictions to China. More on that next. This is Bloomberg. Now back to the market. Stocks taking a little bit of a hit today. Abigail Doolittle is tracking the moves.
Yeah, down a little bit today, Chanel, but on the week and over the last 3 weeks. Take a look at this rally for the S&P 500, up 9.4%, essentially at levels after falling about the same amount from the July peak, back at levels that is causing some investors and traders really to talk about this year-end rally that we might just see a continuation of this move. Now, if we flip up the board, we are going to see that the driver, the macro driver for this rally, because of course we've had earnings as well. Take a look over the last month. So it's not an apples to apples time period, but you get the picture. Yields down in a big way. That 10-year yield down 40 basis points at 445. Interestingly enough, still hanging on by a thread to an uptrend. And then the Bloomberg Dollar Index down nearly 2%. Risk assets denominated in dollars, when the dollar goes down, well, it helps them go higher. As for the S&P 500 itself, let's take a look at a revised version of a chart we haven't looked at in a while. So this is the S&P 500. This was last year's downtrend, then the reversal of it starting last October into this year. We're now seeing a mini version of this. It's hard to know how high this move higher will go, but it's likely to go back down to some degree. This is a weekly chart, consolidate the gains, and then we may be looking at a bigger rally, but that's a long way of saying we could have some wild volatility in the weeks, maybe even the months ahead before perhaps the buyers step up. And then finally, over the last month, these are the big winners, Expedia, Netflix, D.R. Horton, and Intel. These companies really putting up blowout results, even though they're very, very different. And of course, D.R. Horton getting a bit of a bid from interest rates going lower, the home builder guy, and then Intel up 20%, one of those laggards, really making a nice catch-up play in the chip space.
Just the volatility is incredible around some of these single stocks right now. Hard to pick. If you get them right, great. If you're short, horrible. But there's also some big losses coming through as well. Abigail, thank you very much indeed. Wow, what a week it has been. Let's talk about one stock that is certainly having a tough day. The largest manufacturer of chip-making machinery in the United States is the worst performer on the S&P last time I checked. Shares of AMAT, Applied Materials, down the most in a year. And the reason for this is nothing to do with the financials. It's to do with an investigation. It's to do with supplying China with chip equipment making kit that maybe was not allowed. Mandeep Singh of Bloomberg Intelligence joins us now. Mandeep, can you just walk us through what the U.S. authorities are concerned about?
Yeah, so look, last year, I think it was in October, there were restrictions imposed on all of these companies around what they could export to China. And the way these companies, in fact, Applied Materials did quantify the impact. It was around $2 billion, about 6 to 10% of their sales. And when you looked at this quarter's results, China was almost like 45% of their sales, and there was this big shipment to SMIC, the largest foundry in China, for DRAM equipment, and I think that is what the investigation is about.
Does it say anything more about the U.S. national security crackdown when it comes to these big companies?
Well, so clearly the curbs were imposed, and these companies found a way to keep selling to China. Now, I don't think there was explicit mention of, them selling something that was restricted. And what China seems to be doing, especially on the foundry side, whether it's SMIC or YMTC, is really import whatever they can get. I mean, these are not like leading node equipments. These are probably lagging nodes, and they're just getting whatever equipment they can get at right now.
Why such a big reaction in the stock? What impact could this have on the business?
Because I think the headline number where China was 45% of this quarter's sale was everyone caught, I think it caught everyone's attention. And look, I think it was surprising given the outlook they gave last year, which was this is going to be a headwind and China would be more like 25 to 30% of sales. So clearly, this is much higher than what they guided to.
Mandeep, great to catch up. Always a pleasure. Thanks for stopping by to update us. Mandeep Singh, of Bloomberg Intelligence. That certainly is going to be a subject on Bloomberg Technology coming up a little bit later. Michelle Gonzalez, Global Head of Microsoft's Venture Capital Fund, also joining Bloomberg Technology with Caroline Hyde and Ed Ludlow. But Shonali, as we wrap this week up, it has been such a whirlwind and such a everything rally aside from oil. I do wonder, kind of going into the weekend, whether or not we're going to be seeing people quite as positive going into next week. But the momentum's there right now.
The momentum's there, but you have to wonder if the momentum stays, especially in that bond market.
Yep.
Everyone wants to talk about stocks. We're going to talk about bonds even more later today.
I suspect we probably are. You've got Real Yield coming up. Looking forward to that. That's certainly a fantastic show to tune into a little bit later on. I think the image I'm going to be left with this week is basically Goldilocks sitting in Santa's sleigh. We're heading towards a rally. That's the collision that we certainly seem to be on at the moment. Bloomberg Technology is coming up next. Shonali, thank you very much indeed. This is Bloomberg.